After quite a packed week with market-moving economic news bites, we are now certainly flying higher in the green as we can see the S&P had a spark of light there on Tuesday and began an ascent, now continuing to climb. So today, I want to go ahead and fill you in on what exactly happened with the need-to-know economic insights to get the big picture, key you in on what's most important, then wrap up, as we always do, with dividend stock ideas. 5 of which I have for you today that are just beyond buy and hold forever type of investments. With that, are you ready? So now, investors, if I had to sum up just the past week in a word, I would pitch you on the word exciting. Because we ultimately saw a lot of rallying across the board, especially within the tech sector, all thanks to Apple's latest announcement to enter the AI space. Certainly gave the market an initial spark, and we saw Apple stock soar, along with some of the top name tech ETFs. But then we had a bigger piece of news come out. Well, two really, when it comes down to our market mandates, inflation and interest rates. And both pieces of news hit us on Wednesday. So which do you want first? The good news or the not terrible news, but not amazing news? Assuming I know you well by this point in time, how about we just get going with the good news when it comes down to inflation? As of our latest CPI report, released on Wednesday, it depicted a pullback in the annual rate of inflation at 3.3%, which is down from 3.4% back in April. Now, that's all just a promising sign that at least we're heading in the right direction. However, given 2 of our stocks today actually deal in the construction space and are just heavily impacted by housing data, I want you taking note of the fact that housing inflation still remains hot and stubbornly high, though also falling, but just very slowly. Now, as for the not so terrible news, but pretty decent news, whatever you want to call it, comes down to interest rates. The Federal Reserve announced that they are doing absolutely nothing at this point in time, which was nothing new, and we should have expected that out of the Federal Reserve, but it also now signals that there may be fewer rate cuts than previously estimated. Again, not new news if you are here with me and subscribe to the channel, so let that be your clue in now. And I just want to make another statement here, not to time the market or to use any of these macros to do so, but rather use these macros to understand where now to look for your next big investment, which is where I want to direct your attention right now, because today, as I shared, we have 5 big time players in their respective industries that are all beaten down right now and really have just proven time and time again to be solid performers, gifting their shareholders not only with share price appreciation, but what we're all looking for, growing dividends year over year. So let's go ahead and get to them now with Caterpillar, ticker symbol CAT, up first. As a company that's in the business of construction machinery and engines, you know, all those big yellow construction vehicles that can be spotted all over the world right now? Yeah, that's Caterpillar. And the good news for us investors is that this stock is down because of the bad news for the company, which is that new home construction and all related projects are lagging behind, given the environment that we're in of elevated interest rates and inflation, all prolonging development projects as spending remains very restrictive. Now, you have to understand when it comes to this specific industry, it's cyclical. This just means that it's a time to buy when Caterpillar is faced with harder times. Like right now, this stock is down off its peak of $377 per share at a PE rate now of 14.9. And should you just hold for the long term, you'd experience the growth, as we already saw this past decade, over 304% worth of appreciation. And right now, a lot of favorability from the analysts forecasting over 13% worth of upside, coming up to $373.91 per share, while Caterpillar itself ramps up their share buyback program, as we can see over $3.6 billion spent in doing so to increase shareholder value. But we are here for the dividends. So Caterpillar is going to go ahead and gift you with a very nice dividend coming in at a yield of 1.72%. Small but mighty considering an average growth rate of 10% year over year. And it's been dishing out this dividend for the last 31 years now worth of a dividend streak. Now, on the other hand, if you want to remain within the construction industry to an extent, but go with a brand name that has really played more of an active role in your daily life, it's your time to go ahead and look into Home Depot. It's ticker symbol HD, which is arguably one of the most well-known home improvement retailers in the world. Those suffering from the same exact woes as Caterpillar right now, thanks to all the housing data and even sales struggles, thanks to the rain checking of a lot of DIY projects and all the alike. So here we have Home Depot right now up on the year overall, but off its peak of almost $400 per share, trading right now for $344 per share with a PE at a low here for Home Depot of 22.3. But zoom out with me to see the power of being invested in a quality company over the span of the longer term, whereas we see over 442% worth of share price appreciation over the last decade. And right now, not the only one that's optimistic about Home Depot. Our analysts here are projecting over 14% worth of upside, climbing up to a share price price of $393.20. However, I do want to point out here for all of you to consider that insiders have actually been selling their shares worth of Home Depot over the past few months, along with hedge funds that have certainly been now offloading shares as well, meaning either the worst is yet to come or the worst has come and gone. Personally, being in Home Depot for the long run, it's an opportune time now, and until the rebound, I'm just going to enjoy the 2.62% dividend yield that comes in after a 36-year rich history and moreover a very powerful average growth rate here of 19% year over year. But now if you're looking to stray away from the stocks that might not be out of all the muck of the volatility, you can certainly put your eyes on logistics companies, and in particular a railway company. But before I actually cover this next dividend gem, investors, I want you making your next big investment move right now by joining me in the 25% of you out there who have already subscribed to the channel for one heck of an ROI, given I go ahead and dish out weekly dividend stock ideas on top of all the need to know economics so you can actually perform better as an investor because you're more informed. Trust me, you don't want to fall in that 75% camp. And while you're at it, go ahead and tap on that thumbs up button to let me know that this content is the content that you came here for and you're getting value from, so I'll make more just like this. With that, let's go ahead and talk about Norfolk Southern, ticker symbol NSC, which I just mentioned this past Thursday, but to be honest with you, it is just too good to pass up right now because of the rising costs across the board when it comes to transportation. However, the rails are an absolute necessity for cross-country transport, and those supply and demand as well as expenses might all have misaligned a company like Norfolk Southern. Shipping industrial products, including chemicals and agricultural goods, metals and construction materials, as well as coal, automobiles, and automotive parts, we certainly have a power player on our hands right now that is just down and trading for $224 per share. That's down from nearly $261 per share back in March. And zoom out with me to get this big picture to discover almost 175% worth of share price appreciation. Now, if that doesn't quite do it for you, analysts remain bullish on the stock, forecasting a share price of $272.71. That's almost over 21% worth of upside for you to take advantage of. But here's what has me insanely bullish on Norfolk. The insider activity is off the charts, with directors across the board buying as recently as June 5th, with over $500,000 investment there from a director, with hedge funds also doubling on up with this opportunity, scoring well over 715,000 shares last quarter. And until we have an actual rebound, Norfolk's dividend will get you chugging right along with them, currently at a 2.41% yield that has been on a streak now for the last 22 years and growing by an average of 16% year over year. Now, at this time, while consumers are still quite pinched and the restaurant industry as a whole has just been quite stifled from inflation, high wage demands, and ultimately just higher overhead burdens, I think we really have quite an opportunity on our hands to snag with McDonald's, ticker symbol MCD. While the stock is trading right now down in the dumps of the red here for $254 per share, that's down from nearly $300 back in March with a PE at 21.6, but zooming out, seeing over 225% worth of appreciation makes me confident that McDonald's will certainly be on a comeback soon. And the reason I'm so fired up about McDonald's is the fact that it's not necessarily investing into the burgers here we're talking about. It's a business that is in the real estate game and is an undercover real estate powerhouse, all thanks to the McBusiness model that they have over there, leasing out locations to all their franchisees. It is just a pure money maker. Now, analysts are feeling very similarly with their buy ratings, projecting upside coming up to $308.28 per share. That's about over 21% worth of upside. And until then, it's going to be all about devouring the dividend thanks to the yield coming in at 2.62%. That has been in the dividend streak here for almost 50 years, just surpassing 47 years now, all while growing by an average of 15% year over year for the last 20 years. And now for the one stock that I just cannot get enough of right now, and of course as a long-term investor just appreciate it very much for appreciation and dividend growth, let's talk about Visa, ticker symbol V, which I have been speaking a whole lot about rather recently, as I feel it is just a powerhouse for all of us to take advantage of, and I don't want you missing out on this opportunity to invest into a business with arguably one of the cleanest balance sheets, all thanks to their business model of collecting on all the fees when we swipe our credit cards and just avoiding the lending business entirely. But in terms of the share price, Visa right now is trading for $270 per share, which is down from the March highs of almost $290 per share, and we'll be back as consumer trends shift back to where they were. Yet I want you focused on the long term with Visa, as we could see it soared by over 450% over this past decade, and more recently, Visa has been pouring money into ensuring that their shareholders feel valued by buying over $2.8 billion on a share buyback buyback program to add extra value in there for all of us. Now, analysts are just continuing to remain very bullish on the stock as well, forecasting over 17% worth of upside, climbing up to $316.40 per share. Now, until then, shareholders get the luxury of a growing dividend with Visa as the dividend just continues to grow, a current yield at 0.77%, though of course growing there by 18% year over year, and committed to their dividend streak here of 15 years now. Investors, there you have them, 5 powerhouse dividend investments for the buy and hold for the long term right now. Let me know your thoughts on all of them, or if you have better ideas in mind, comment down below. Definitely be sure you're subscribed to the channel now by this point in time, and catch all the latest insights right here in the next one.